Just quickly, myself, Justin Nadile, co-founder and partner of Blockwise Advisors, proud Cubic Labs member company. So just shout out to Ian and those guys. But we work very closely with both public and private sector entities to help them unlock the value that blockchain has to offer. But I'm just also very personally curious and interested in this stablecoin space as really one of the key tenets of everything that we're building here, whether it's DeFi or bringing traditional finance on chain and things like that. And I also will say this will be the first of two very exciting talks on stablecoins. We're honored to have Nick Carter from Castle Island Ventures here giving a keynote on stablecoins as well tomorrow. So this will hopefully be a good lead up into that discussion. So with that being said, but before we dive in, I'll ask each of you just to offer 30, 45 seconds on your backgrounds, your focus on this space, and then we'll get into the meat of things. So, Saul, you want to take it down there?
Yeah, sure. Hi, everyone. Great being here. I'm Saul. I lead product at Metrika. We're a Boston-based global startup, I guess, in the blockchain ecosystem. We provide observability and monitoring and risk management for blockchain applications, working with everything from the protocol teams building the actual chains to financial institutions leveraging those chains. Yeah, prior to this, I'm originally from Latin America, so I've been involved with blockchain since 2012, 2013.
Cool. Yeah, I'm Austin. My background is a little bit boring TradFi in a lot of ways. I was at JP Morgan for a long time running cash stability products. Got into crypto in about 2018, and for there I've been at Stone Ridge, which is one of NYDIG's parents. So helped with building a custodian, lending operations. I've been at Citi in the digital assets group, and I was at Paxos, where I was the head of the stablecoin project there and the chief risk officer.
Good. Well, great, guys. Really appreciate you both being here. And so I wanted to lead off with just some insights into a prep session that we had, which went in a little bit of a different direction than I anticipated, and that means nothing because you guys are the experts here. But I initially approached preparing for this panel with you all with a focus on how things like regulation and policy drive commercial adoption and commercial use cases. And as we started chatting about both of those respective areas and recent developments in each, we started to think maybe it makes more sense to approach this in the reverse, where a lot of the recent developments that we'll talk about here today are actually on the commercial side. Commercial side is not waiting for government in a lot of cases, right? And in a lot of cases, they're actually forcing the government's hand when it comes to stablecoin regulation and policy and everything related to that. And so, we're going to talk about things like the introduction of PayPal's stablecoin, Shopify introducing Solana Pay as a payment option to all of their hundreds of thousands, if not millions, of small business merchants today. And then some of the developments in places like the Caribbean and Latin America with Mercado Libre and Island Pay, and how adoption outside of the US affects things like dollarization, right? Which is a pretty heady concept, but we'll touch a little bit on all that today. So, but before we get into the fun stuff, let's start at the most basic level. So Austin, what is a stablecoin?
Oh boy, all right, putting me on the spot. So when I teach, the definition we use for a stablecoin is just a stablecoin is a representation of a unit of fiat currency on a blockchain, right? Like all systems where you're exchanging value need money, right? To grossly oversimplify the statement, stablecoins are just money on a blockchain. I think back to the regulatory point, one of the most important things that falls out of that very quickly, though, if you understand that, is being anti-stablecoin is basically being anti-commerce on a blockchain, right? You are fundamentally against their use for economic activity if you're against money being represented somewhere.
Got it. And Saul, maybe take that to a little bit of a deeper level. Not that we're going to get overly technical here, but Austin, now sort of conceptually what it means to be a stablecoin. How about from a little bit of a technical perspective, what does it mean when someone has a dollar and then that dollar is on-chain in a way that they can use it? So.
Yeah, sure. So, I mean, the technical definition would be something like a stablecoin is a claim on a U.S. asset given to you by a smart contract running on a blockchain. That's a bunch of words. I mean, I think an easy way to explain this would be, it's essentially, think of it as a digital certificate that says that you have ownership over a dollar. And that dollar, you trust the certificate because you trust the issuer of that certificate, which could be, Circle or Paxos or a bank in the future as well. But essentially, like what it means is essentially that this certificate, you can go and exchange it for a US dollar anytime that you want. Behind this, there's a whole infrastructure, both on the blockchain itself and then on the different issuers of this, stable coins, which entail, if you're using USDC, Circle has the dollar that you give them. In theory, they have this in an account somewhere, and you can, trust that they actually have it because they're well regulated and audited and so on. But at the end of the day, you're trusting that that institution has that fiat stored somewhere or invested somewhere for you. And that refers specifically to fiat-backed stablecoins. There's a whole discussion, and I mean, Austin was, testified about this. But there's a lot of talk about what should be called a stablecoin, because there are other assets that are called stablecoins that have either a portfolio of fiat currencies behind it to back it up, or there's like purely digital asset-backed stablecoins which have a portfolio of digital assets like Bitcoin and others that are kind of like, instead of having a US dollar, they have that as the asset backing up your claim over it.
Got it. And I think it's fair to say, guys, correct me if I'm wrong, when we think about stablecoins for this discussion, we're going to focus mainly, if not entirely, on traditional fiat-backed stablecoins. So that's your USDCs of the world, maybe your tethers, wink, wink, nod, nods, depending on your view on that, but less so the DAIs or the Fraxes of the world, right? So just point of clarification for the audience. So let's talk about one of the recent developments here, and at least my perspective, maybe the most recent notable commercial development over the last maybe month or two, and that is PayPal's announcement of PYUSD as a digitally native blockchain-based stablecoin that will be, I believe, fully integrated into most, if not all, of their payment solutions. Austin, you were at Paxos before your current role. I know you can't disclose all of the discussions, but Paxos is a critical part of the PYUSD ecosystem. So if there's any inside knowledge that you could share as far as, I guess, did PayPal come to you? Did Paxos go to PayPal? I guess, what was the genesis of the idea? And again, maybe some of the machinations along the way.
Yeah, so I think, I'm just building on some of the things that have been said publicly here. But if you really think about the implications of blockchain, like a peer-to-peer network for the mutual exchange of value, that is an existential threat to PayPal's business model as it currently exists. And they understood this pretty early on. So I would say there were two parallel stripes of thinking at Paxos where we were like, well, this is an obvious company that should probably be looking at this because they have a whole competitive and innovation problem. But if you look at people like, say Jose at PayPal, he got that very early as well. So there was a, if you will, mutual coincidence of wants between those two companies for that. I would also say what's interesting about PYUSD is this was not done with the goal of providing a solution to the people who currently exist in crypto. PYUSD is existing to be able to use money in new ways and bring new users into crypto. And in an ideal world, I think from PayPal's standpoint, abstracting away the fact that they're even using crypto when they do it, right? Because one of the things you'll hear from that team often, and I'm not sure I disagree, is crypto will go mainstream when nobody has to think about the fact that they're using crypto.
Got it. Very interesting. And Saul, maybe touch on, and I don't believe, correct me if I'm wrong, that Metrika works with a PayPal or a Paxos today. Maybe you do. But how does a company like Metrika, itself a network monitoring platform, I think is a fair way to look at it, how does that help enable someone like a PayPal to launch something like a PYUSD? How does it give them comfort that once it's out there in the wild, they have visibility into it and control into it? Yeah. So how do platforms like yours allow for that visibility, to allow for that comfort?
Yeah, I mean, I think the way I think it's easy to understand is if you think of how we evolved as a company. So we started working with the protocol teams themselves, so teams like Algorand in Boston and others like Dapperlab and so on, building the visibility that they need to run their chains and make sure that the blockchain itself, so the L1, is running healthily. Through that, we started working with the node runners of those chains. So remember, like blockchains are, the true ones are decentralized systems, so nobody owns or controls or has full visibility into every single node. So we started developing tools for those persons or institutions running the nodes to be able to guarantee that the nodes are healthy and that therefore the network itself is healthy. And through that work, we started working with institutions, regulators, and so on that are building on top of it. So smart contracts for tokenization, custodian, staking, and so on. So through that work, essentially, stablecoins is just one use case of a more broader use case with blockchain, that's tokenization. So tokenizing real world assets. In this case, it's a US dollar that you're tokenizing, but essentially it's the same principle. So if you're an institution that's issuing this, or if you're a regulator and so on, you can use Metrika to make sure that the system is working as it's supposed to be working, both on the smart contract level as well as on the underlying blockchain level. So if you want a concrete example, we're working with a bank that is actually issuing their own stablecoin, and they're using it, as you said, like none of their customers will know that this is being used in the back end. It's part of their financial rail, like piping. Right. Most people don't care to know how their money is being routed and like what system is being used. So they're using this to do cross-country settlement. So they use a platform like Metrika to guarantee that first to evaluate what blockchain they should be using, because not all blockchains are as healthy, as stable. And then once they choose one of those, they can monitor that chain to make sure that it's healthy and operational. And then if they detect any issue on the risk side, they can use Metrika to mitigate and to act on it.
Got it. Great. Thank you. And Austin, just to continue along a comment that you made as it relates to PayPal's motivations, largely not targeted at existing crypto users or natives. This is to bring a whole slew of new folks into the market. Whether they realize it or not, it's almost moot point, right? They just want folks involved here. So another recent development, Shopify announced that they're integrating Solana Pay, which will allow their millions of merchants to accept USDC, I believe, directly within each one of their storefronts. Would you characterize that as a continuation of that same theme around, hey, this isn't really geared towards the existing stablecoin use cases. This is actually trying to open it up to new folks as a way to, hey, prove out maybe this is that proverbial killer use case that everyone is desperately wanting for, right? So a continuation of that motivation, would you say, or?
Yeah, and I would say I think we've already found the killer use case of blockchains, which really is stablecoins. I think the thing to remember when you're sitting in this room is some of the people in the world for whom stablecoins have the least immediate utility are people already in the United States. Right? We have a financial system that works pretty well. We have dollar rails that work pretty well. I can pay at the deli at 2 a.m. in New York, where I live, with my credit card, and it's fine, right? That works. That is not the case in many places. So as you look at the integration of things into consumer apps where you're using stablecoins in the background, or you look at sort of these design decisions to put stablecoins out into the world, I think while some of that is relevant here, the reality is that is going to be picked up in other places where it's a larger marginal benefit for those people faster. And as evidence for that, when I was at Paxos running BUSD, we were 22.5 billion at about the peak. Over 95% of our users, non-US persons. A lot of them were clearly using this to pay each other peer-to-peer, regardless of the blockchain. And so I would say this is more formalizing what has already emerged as the killer use case and professionalizing it so that it could scale.
Got it, great. Let's use that as a segue into a little bit of the sort of policy, regulatory, geopolitical angle to all of this. Mentioned earlier, there have been some interesting, again, commercial developments in Latin America, in the Caribbean, again, whether it's Mercado Libre, which I believe is sort of integrated stablecoins from a transaction acceptance perspective, Island Pay from a cross-border, cross-island perspective in the Caribbean. Saul, maybe just given your unique perspective coming from Venezuela, just some thoughts on some of those commercial developments and what you're seeing, again, given your perspective there. And then we'll transition over, okay, how does that force the hand of government to actually do something?
Yeah, I mean, I think I couldn't have put it better than Austin, but I'll say two things. I'm not surprised about the demand for this outside of the U.S. for two reasons. One is regulatory. So like there is more regulatory clarity in a lot of other jurisdictions. Europe has MiCA. The UAE is super friendly with crypto. Like there's governments, believe it or not, that are actually saying, come do business in our countries. We want the industry. So I think there's a lot of that makes financial institutions and startups and different players more willing to, experiment in the space and actually leverage it for for making their business better. I gave the example of the bank that's doing a stablecoin issuance, abroad. There's SocGen is doing it, NAB is doing it. There's many more that are working on this. You don't need to come from a country like Venezuela to benefit from it, because if you're a bank in Australia and you have customers all over the world and you want to do immediate settlement across all your branches, guess what? Stablecoin is a great way to make that happen. So that's on the regulatory front. And then on the demand side, as Austin was saying, I think we underestimate what it is to have a stable financial system if you live in the US, as we're all fortunate to do. But if you're from a country like Venezuela, I grew up with hyperinflation, capital controls, which essentially means you could only buy a certain number of dollars per year, or you have to go to the black market, which is unaffordable for most people. So if you're coming from a place like that, be it Venezuela, Argentina, Lebanon, many other countries, this and stablecoins, but crypto more broadly and digital assets more broadly, is a way for you to have financial inclusion in a stable. If you have a stablecoin, if you're using just crypto, maybe not as stable, but still a way for you to preserve your wealth, outside of your own country. So, I'm not surprised by the developments of outside the U.S. having so much demand for all these use cases.
Got it. Great. Anything to add, Austin, or do you want?
No, I think that's very on target, and I think it relates to this point I was making earlier on. You're going to see adoption in places where there's the largest marginal benefit. Like, one of the key things about crypto in many ways is the fact that it's an open access system, which again, we easily underestimate the value of in the United States. But I dare you to go try to build a business on top of JP Morgan's banking rails without telling JP Morgan about it and see what happens, right? When you have an open access system, in addition to being a large immediate marginal benefit in these places, it's almost permissionless as to who can do it. So everybody can pile in and innovate and combine things, and composability is the term you would use in crypto, in a way that unlocks not just local value, but a lot of combination value that's hard to see until it happens.
Got it. Okay. All right, so let's shift a bit here in the last 10 minutes to the geopolitical angle. And I know you both will have strong opinions on this, which we love. So there's this concept that's been floating about more and more called de-dollarization. You guys may have better definitions. I just generally think of it as less international commerce being denominated in dollars, right? Again, that may not be perfect, but generally how I think about it. And as we talked about some of the commercial adoption of stablecoins outside the US, ostensibly that drives demand for dollars, right? Which just improves or enables the dollar's position as a unit of global trade. That's great, but then we have domestic policymakers and regulators who are taking a bit of a different tact that could actually affect the dollarization or de-dollarization trend that we're seeing. So Austin, maybe you can just touch on a little bit of what you've seen and heard given your travels on Capitol Hill. How do folks think about this trend? Where is it on their priority list? Do they understand maybe not even the technology, but the implications of the technology? And how does this affect actions that they're taking either this cycle or next cycle from a political perspective?
Yeah, I mean, I think I can pretty confidently say I don't think we've had a great grasp on the long-term implications of the United States. Because if you think, to complete Saul's list, if we think about places that have legitimate stablecoin frameworks in the world now, it is Japan. Hong Kong is publishing theirs probably late this year, early next year. Singapore is already done. You can get a major payments license from them. You could do it in Europe under MiCA. You could do it in Bermuda, which, by the way, third largest insurance regulator in the world. That is not a backwater, right? And yet in the United States, if you want to launch a stablecoin, really the only place you could do it in regulated fashion is New York, right, under the NYDFS. And even they are constantly having fights with the feds about what they are allowed to do and what they are not allowed to do. So we are actually very significantly behind. If you think Massachusetts is unfriendly to innovators, to piggyback on the last panel, go to France. And yet I want to point out they have regulation and rules way ahead of us here in the United States. What is going on? So I think that's one element, is that our choice globally is yes, stablecoins in the US, or just yes, stablecoins offshore, right? The idea that you could stop this, it's not a thing, all right? Two, in the United States, a lot of the people who are anti-crypto, I think, are in many ways more pro-intermediation and pro-centralized control of financial companies, right? If you look at the concerns that are driving them, you talk about KYC, AML, and commentary coming out of the Treasury. You talk about financial stability and the ability to control distinct choke points, like some of the enforcement folks at the Fed. If you talk about wanting to limit the activities of financial companies, period, full stop, at the FDIC, that is more a statement about control. And the more centralized a system is, the easier it is for them to control it. So if that's your viewpoint, this is a natural enemy. The flip side of the coin is, again, I think the point we're missing in the US is you cannot stop this force. You can only stop us from using it. Because as a general statement, when I was at Paxos, there's only one country in the world where we were absolutely certain nobody owned one of our stable coins. And that was North Korea, right? So the key to stopping this is you have to take the internet away from your citizens. So my view is in Washington right now, I don't think they really get that because of the current administration. I do think probably starting in 2024, we're gonna have to grapple with that more as other places continue to license more, launch more, and Congress really is now very far behind the 8 ball. I also think, to be totally honest, there's a chance that there's some trade-offs in the upcoming budget fight, because I know one of the priorities for the Republicans in House Financial Services is going to be either the stablecoin bill or the market structure bill. I think it's TBD on which.
Got it. And if I could ask you just to double-click into sort of a line of commentary there, even if there was a world where Congress woke up one day and said, ban stablecoins, no U.S. citizen can own a stablecoin, it's not a means of trade, et cetera, that doesn't mean U.S. denominated stablecoins go away, because there's this concept of an offshore stablecoin, right? Which is, I think, how we classify something like a Tether compared to a USDC. Yes. So maybe just sort of explain that a little bit more, what it means to be offshore versus onshore, and that Uncle Sam's reach actually only goes so far in this case.
Yeah, I mean, so we could back up to a traditional financial concept for that, which you're going to get a lot more from Nick, so I'm not going to front run his comments too much. He's a friend of mine, I know what he's going to say. But it's just, there's the dollar market, which we typically think of as US dollar denominated money within the US system. And then there's the euro dollar market, right, which is US dollar denominated money outside of the US system. Unless we want to stop trading with people in dollars, period, there is no way to stop euro-dollar stablecoins, right? Like, I'm familiar with a project that is building a stablecoin in Hong Kong right now that does custody with Chinese banks and gets all of their T-bills from China. How do you stop that from happening? You would have to stop letting China buy treasuries. Anyone? Right? So we can't control non-US euro-dollar markets very well. I mean, we can influence them some, fine, but we can't really control them. And so again, this is kind of my point on the technology is coming whether you want it or not. Like, banning forms of technology as though the innovation will just go away historically has never been a successful tact for anybody. And we don't want to put ourselves in the position of, Henry Ford invents the Model T and we tell him, get out, we hate this thing, and then all of the giant automotive innovation is in Europe. But that is what we're doing now.
Got it. So a couple minutes left, guys, and then we'll wrap up. This has been fantastic. Saul, I'm going to kick this one over to you, just maybe as a way to increase the willingness of policymakers to understand and believe in the concept of stablecoins, and that's through the use of technology, whether it's Metrika's or someone else's, from a monitoring perspective. Are there technical tools and products that can be presented and or developed, if they don't exist today, that would benefit the conversations that someone like Austin has at the policy level to say that, hey, with this tool, maybe it's not control, but it's visibility, it's so on and so forth. So,
I mean, obviously I'm biased, so I would say Metrika is trying to help there. We're not the only ones, and the problem is big, and we need as many people as we can to help. I think it's not a tech problem at this point, frankly. I think, to Austin's point, I think what we need is the clarity to know if we can build this here or if people will have to build it abroad. I think from a national security point of view, to me, it makes no sense that we're gonna send this industry abroad. And if you want to keep some level of control over it, I think it makes more sense to keep it in the US. Like if you think about it, not only is it not a tech problem, but from a regulatory point of view, is not really that novel either. I mean, I think you mentioned the Eurodollar market. If you think of money market funds, in the 1970s when they were introduced, again, traditional banking pushed back a lot against them, but it's, I think, a lot of parallels with what a stablecoin essentially is.
Right.
It's a great product for us to export US dollars all over the world to people in countries that have unstable economies, but also to countries that have very stable economies, like all the countries that Austin mentioned. So I think we just need to give that clarity and that framework so that people can build the tools to make it happen.
Got it.
Yeah, I would even take that one step further and say, please, this is not financial or legal advice, but if you're ever going to commit a crime...
We should have led with that, by the way, but sorry.
Yeah, but if you're ever going to commit a crime, do not use a blockchain, use cash, right? Like the degree of traceability and the amount of information that public blockchains leak, I think people don't fully understand. But I would tell you, it is my personal view that over time, if you really understand how a blockchain works and how you can use token standards and like the analytics that are being produced by companies, these are going to be far more effective for interdicting financial crime than the current system, which is very opaque, very fragmented, and very difficult to understand from a regulatory and like legal point of view. Think about it this way. If you're a prosecutor and I tell you, here's your choice of systems, okay? System one, money comes out from an ATM, you have no idea what happens, and then at some point a year later, money goes into an ATM, all right? System two, you know the out, and while you don't know the specific identities, you know the time, amounts, and pseudonymous IDs involved with every single transaction in a chain, and then money comes back in. And by the way, that's all public and you don't need a warrant. One of those systems is much better than the other.
You'd think if you were a member of the forensic accounting team with the FBI, you would much prefer a criminal commit a crime on the blockchain versus maybe envelopes of cash, at least from a traceability perspective.
I would say I think the biggest problem is the FBI blockchain team is literally 5 people.
Well, good. Well,
we can get there.
We can get there.
But
Well, if anyone's
we are the
looking for
problem.
forensic accounting jobs, maybe ring up the FBI, see if they have anything to offer. But with that said, guys, thank you so much. That's the close of our panel here. Hopefully you all found this interesting. Our panelists will be milling around for a little bit afterwards if you want to come over and say hello. But otherwise, stick around for the keynote tomorrow, which will be part 2 of 2 as it relates to stablecoins. But thank you, Austin. Thank you, Saul. Appreciate it.
Thank you.
Thanks.
Well done.